Welcome to Investors Edge, powered by SNL. Today's guest is Karun Arya, co-founder and chief growth officer of GetVantage, a fund helping startups secure their growth capital via alternate financing. Previously, Karun has 16 years of experience leading corporate affairs and development experience across Asia Pacific for Orient. Karun has also served as a director at Discovery Networks Asia Pacific and has been one of the first few employees at Uber Asia, leading as head of communications. Karun, you're also an active investor and startup advisor. Welcome to the show.
Thank you. Great to be here. Thanks for having us.
Awesome. So we wanted to get started by talking a bit about GetVantage. GetVantage offers a unique alternative to traditional funding by providing non-dilutive growth capital through revenue share agreements. Could you explain us how this model works and the benefit it offers to early stage startups?
You saw this big movement in Silicon Valley decades ago where VCs became a thing, right? Like it was cool to be funded by a venture capitalist. It was cool to speak to venture capitalists. And it was cool to essentially be an entrepreneur in Silicon Valley. That's obviously, those winds have obviously blown over onto the rest of the world as well. Having said that, I think unfortunately we've been plagued by a fascination around venture capital in our countries, where there is this big misconception around the fact that my company is successful if I've raised venture capital money, or if I've been able to raise 10 million, 20 million, $50 million. But that's not true, right? I mean, your business is successful if you're profitable, if you're making money. And along the way, a lot of people seem to have forgotten that. And while they're in the process of fundraising, I think once you're a founder, once you've been through that process once or twice, you start to understand and appreciate just how hard it is. And in many cases as well, why it's full of friction when it doesn't need to be, right? But that also stems from the simple fact that you do not need to dilute equity at every stage when you're fundraising. There are many forms of capital out there, and it's really important for founders to firstly understand what are the options available to them, when are they appropriate for my unique needs as a business owner and my business that I'm building and the journey I'm on, and how can I leverage each form of capital at the right time to meet the very specific objective that I might have. And that's really where our kind of funding, where we call it, I mean, there's so many different names you can give it. It's revenue-based financing, alternative financing, non-dilutive financing, quasi-equity as well, is what it's called in some cases. That's where we come in, because what we decided was that, one, there had to be a better way. We've been through that process and the struggles of fundraising as founders and operators before. And it shouldn't be that hard, right? There has to be a way where it's not all based on who you know. It's not all based on what your background is as a founder and what you've accomplished in your previous avatar. But it should really be based simply on business fundamentals, right? If your business is a good, fundamentally sound business and is generating revenues, why should it be hard for you to access capital? And that's really where the fintech-driven approach to revenue-based financing or cash flow-based financing comes in, where using the advantages and the advances that we've made in technology, using that to really be able to look at both traditional and alternate data sets for a company's finances, cash flows, revenues, sales, marketing spend, all of these different sort of signals, and based on that, underwrite the business for what its potential is as well. But not potential in the long term, because that, again, that's knocking on the equity investor's door as risk capital. But what is your short-term objective, short-term growth objectives, and how can the immediate funding requirement fuel a lot of that? And I don't know if you've come across this stat before, but 40 to 60% of every venture capital dollar raised today, or even 5 years ago, goes straight to Google and Facebook for digital marketing spend, right? That's an absolutely insane statistic when you think about it, that, okay, I'm going to sell 1% or 10% of my company for X amount of money. but I'm going to take 40 to 60% of that money and give it straight to Google and Facebook, right? And that's why we started. And over the last 3.5 years, that's what we've been trying to do is, one, make the entire fundraising process as frictionless as possible for founders. So remove all of the cumbersome paperwork, the timelines of being courting investors for months and then being rejected for a pretty benign reason most of the time. Not having to give up or put up any collateral, right? So removing the need for collateral, letting data be the new collateral for these companies, making sure that the founders don't need to put up any personal guarantees as well. All of these things have been hurdles to traditional funding and access to traditional funding. And that's where we saw this opportunity where revenue-based financing, because of the tech-first approach that we can have, we can eliminate bias, you can eliminate collateral, you can eliminate paperwork, you can eliminate interest, you can eliminate equity, you can eliminate board seats, right? And one of the other things we like to say, it's a bit of a marketing speak, but you eliminate all the bullshit and the excuses as well, right? That typically comes with fundraising. And it's a binary outcome. It's a yes or a no, and you know that within 48 hours. I think the other advantage about sort of revenue-based financing and short-term funding is that you're able to very quickly calibrate and recalibrate, one, how you're going to use those funds, where it's going to be the most impactful. Is it working or is it not? So you can course correct very quickly as well. And the repayment terms are actually very flexible. So they're based in line with what the founder needs rather than what the investor needs, right? And more often than not, I think what you'll see with revenue-based financing or alternate financing as well is it's a far more founder-friendly method of financing because it's been built ground up with the founder in mind.
So you say that you're picking the best pieces of traditional funding or VC-backed funding and putting them into this alternate model, apart from the hurdles that it poses. But why would someone choose alternate financing? It's as easy to get traditional VC funding.
So I think, I'm not going to actually criticize the venture capital space. I think VCs are a very important part of the financing landscape. But at the same time, there has to be room for others, right? And other forms of capital. And that's really what we try and say. It's not that revenue-based financing or alternate financing is going to supplement what venture capital does at all, right? That's not the case. It's about, as a founder and as a business owner, understanding when is the right time to dilute equity and raise equity financing from a venture capitalist or other institutions. And when is it the right time to raise other forms of capital? And that really depends on what the use case is. So if you're an early stage business, trying to get your business off the ground, so to speak, you are going to have to raise equity financing, right? So either you're going to go to friends and family and say, hey, here's a piece of my company and I'm in exchange for X amount of money, or you do the same with an early stage VC. You might also go and do crowdfunding, right? You may also go and raise financing from other sources, even at that very early stage. But as you are generating revenue and as you're looking to hit the next level of growth effectively, there's going to be 2 or 3 or maybe more areas within which you're specifically looking to invest. One of those will always be marketing, because you're always trying to acquire new customers, whether they're B2C customers or B2B customers, but you have to raise awareness and drive that customer acquisition. So marketing tends to be probably the most significant area for most businesses and founders that they would be looking to invest in. Apart from that, it would be things like other growth activities. So whether you're looking at product expansion, you're looking at hiring, you're looking at other CapEx and capital intensive areas as well for growth. And all of these are actually areas which don't require you to spend any equity money. Equity money should be spent on high risk, high reward areas, right? So if you're doing product R&D, by all means, invest your equity money there. If you're potentially looking to open up a new office in a new city, by all means, use some of your equity money for that as well. But if you're looking to spend, $5,000 or whatever, 5 lakhs a month on Google ads and Instagram ads and Facebook ads and whatnot, it's the worst idea in the world to be spending equity money for that, right? So I think it's just that simple. It's not about whether it's VCs or alt VC or alternative financing, as we call it, but it's about both of them coexisting, both of them being complementary to each other, and founders really understanding and being able to appreciate when should I be leveraging either or both. And I think that's the crucial part of this. Is it's not about one or the other. It's about understanding both and using both for the best outcome for your business.
I see. So tell us a bit more about, what kind of business would benefit the most and at what stage? Like, is it just a part or portion of their growth that they need to be associated with funds like GetVantage? Or is it a different milestone or starting point they should be aiming at?
Sure. No, great question. I think it's actually really simple. I think as soon as you're generating a decent level of revenues, and for a company like us, for a platform like us, we typically say if you're doing about 10 to 20 lakhs a month as a bare minimum in terms of your MRR, that's a good starting point. A sweet spot would obviously be if you're anywhere between, say, 40 to 60 lakhs a month, right? But we also work with businesses that are doing, millions of dollars a month in revenue, right? So it's really quite a broad spectrum of businesses that we can cater to. And I think that's, again, it goes back to showcasing the beauty of why alternate financing is so accessible, so founder friendly, and so fair. Because if you're looking and if you're basing your decision making purely on the data and the business fundamentals or the performance of a company, I mean, it's black and white, right? Data doesn't lie. And you can't make up some kind of excuse to say, oh, I don't feel like funding this company, or I just funded a competitor and I won't fund this.
Mhm.
As a sector agnostic, as a essentially founder background agnostic company, it really doesn't matter who you're funding. You're just in it to try and fund or make funding as accessible to as many startups or small businesses as possible. And I think that's one of the key differences with venture capital as well. Is many VC firms are very focused on specific sectors. We're sector agnostic, right? Many VC firms have a very definitive thesis behind which they fund companies. Our thesis is if the company is generating revenues and ticks all of the boxes we look for, 100% we fund them, right? There's almost no scenario in which we won't for that kind of a company. And I think the more transparency you're then able to provide founders with, it only benefits them because they know what that process looks like, they're prepared, and you don't waste anybody's time, which is really valuable as well. And you're not dragging on the fundraising process for months and months on end.
That's wonderful to know. However, keeping funds sector agnostic has its own challenges. Like, how do you determine the funding amount, the repayment structure, or generally, like, how do you make data collaborate with how much you're going to support a specific company?
Sure. Again, great question. And I think it really depends on how you set up the business or the platform, right? And I think that's really what we spent when we were founding GetVantage, and this I'm talking about 3 years ago now. We didn't try and see who we could fund on day one. We actually spent the first, I think it was 6 to 9 months, just building up our technology base, right? And building up the stack, building up our credit policies, ensuring that we had the systems in place to be able to really look at companies across sectors, understand what their potential was, the potential of those sectors as well. So I'll give you an example. So you take a SaaS company and you take a direct to consumer brand. Very different companies, right? One will have fluctuating revenues. They may have a baseline of revenues, but the revenues will typically still be fluctuating. And for a SaaS company, there's typically a pretty strong indicator of what recurring revenues look like. But both of those will have a very different scorecard developed for them because they operate in very different sectors. I think if you approach designing alternate financing like that, you're going to be at a much more healthy stage of disbursing the kind of credit you want to the maximum number of businesses that are eligible for it as well. So while you're absolutely right, I think there's always a pro and a con in terms of whatever approach you take. I think when it comes to alternate financing, if you're trying to be true to the thesis of making funding accessible to the most number of businesses, it's reasonably easy. Nothing's easy, but I said it's reasonably easy to do that if you've, at a granular level, if you've taken those steps to implement each of those key activities, key actions when you're building the company ground up, right? So after a while, when you have a reasonably solid base of data already input into the system, then you can also do things like start to benchmark. So you're benchmarking companies that operate within a sector against each other or against the industry in terms of overall growth. And that kind of data is very valuable to, well, one, our system, but also to the team that is checking and analyzing whether the output from the system is correct and reviewing all of that before we're then able to make an offer or present an offer to any founder or business that comes our way.
Okay, so help me understand this data. Like, are you creating a funnel which only lets selective startups to be filtered on the other end, or do you use this data to the system to kind of evaluate components? How much will you fund? What stage you'll be involved at, and maybe even the interest rate that repayment structures would look like?
Absolutely. So again, I think you've hit the nail on the head, Priyanshi, which is all of the data that's fed into the system. And it's a really interesting mix, right? So we look at all traditional data points. So we look at your last 12 months financials. We look at your MIS. We would also look at your GST filings, your GST IN data, connect that to our system. And we've already built in connectors. So companies and founders can actually connect their sales and revenue accounts, right? So if you're selling on Shopify or if you're selling on Amazon or Flipkart, you can connect those accounts to our platform. You can connect your marketing accounts as well. So we see the inflows of cash and the outflow of cash as well. And based on the triangulation of all of that data, the system generates an output in terms of what the risk level is, what the credit score of that company is as well. And based on all of that, what is the range of funding that this particular company, if eligible for, could be eligible to get? And if they're not eligible for, why are they not eligible? And are there any improvements that that company or founder can make as well? So a lot of the times, even though we might not be able to fund the company today, for example, because we have that visibility on real-time data of how the company is doing, we often tell a company, we think you might be a bit too early, or your revenues are fluctuating a little bit too much. Why don't you come back to us in a month or come back to us next quarter, and we can pick this up and revisit this again. So I think the ability for us to be able to feed back to founders is actually quite important as well, because it helps them course correct. Not every single time with as much granularity as we would like, but at least gives them some direction on some of the actions that they could take in order to become more eligible for funding via platforms like GetVantage.
Yep, I think this feedback system is going to be really helpful to help them actually grow. Do you have any examples wherein a startup actually chose GetVantage over the traditional funding model, where they traditionally feel a bit more lost?
Sure. I mean, I'll try and give you one of probably our earliest businesses that we funded. I think it was almost 2.5 years ago now, probably one of the first, was a company called Rage Coffee, which I'm sure you would have heard of. They've got Virat Kohli as their brand ambassador now as well. And so Bharat Sethi, who's the founder, he's also a great friend of Bhavik and ours. He trusted us, right? So he came to us and he was keen to get funded way back. I'm talking about 2020 now, right? Mid 2020. And I remember, and he had a very clear requirement in his mind. He was like, I need about 10, I think it was between 10 or 25 lakhs to run some digital marketing campaigns, right? And we took his business, we fed it through the system, all of those data points that we just discussed, and we were able to, I think at the time, underwrite and essentially offer him something like 10 or 15 lakhs, right? And he took it. That was round one we did with Rage Coffee. And then over the last 2 years, we've done multiple rounds. Every time, because his revenues were increasing as well, because his requirements changed, we were able to pretty much, I think, every single time give him substantially more. So I think it went from 5 or 10 lakhs to 20 lakhs to 50 lakhs to 75 lakhs, over a crore. And the most recent round we were able to give was something like 5 crores, right? So we've now seen this company go through that journey. And I think what's really interesting about this is over the span of 2.5 years since we've been working with Rage, they had never raised an institutional round. And in the last 2 years, they've raised 2 institutional rounds, right? So they've raised 2 equity rounds after being able to hit those certain growth targets that they had in mind, but being in a much stronger position when it came to negotiations with equity investors, because they're in control. They've used debt and they've used alternate financing to hit very aggressive targets that they've had. So it puts them in the driving seat when it comes to negotiation during any equity investment. And I think that, again, is a real plus for founders, because if they understand when is the right time to use what type of capital, and again, funding has never just meant equity, right? Again, misconception, funding has never just meant equity. It's always meant equity and debt. And I think it's high time more founders sort of realize that and embrace that. I also think, one way or another, reality hits hard. And because of the funding winter that, the ecosystem is going through right now, many, many founders are waking up to that reality, saying, man, it's really hard to fundraise, right? Or the conversations I'm having are prolonged. They're taking much, much longer than I thought they would. And again, if you look at the broader macroeconomic signals, nothing's really going to change for the next 6 months, right? We will definitely see a turnaround as we kick off next year, but it is going to continue to be hard. And at the same time, I think most equity investors are also changing the way they look at businesses, right? So they are being far more practical in a way where those lofty valuations are out the door, and they are looking very decisively at what is the path to profitability, right? How are these businesses reducing burn? How are you optimizing marketing spend? How are you optimizing hiring and other things around growth? So investors are not just being more cautious, rightly so, but they're also being far more mindful, as opposed to just saying, yeah, I'm going to cut you a check for X millions of dollars based on an idea, right? I don't think you're seeing too much of that, at least not right now.
I mean, debt financing does sound pretty attractive, but most of the founders we talk to are apprehensive because of the interest rate it comes with. So, how does GetVantage address these concerns and provide a
Yeah,
transparent alternative?
sure. Again, great question. And again, very interesting for a company like GetVantage, because the revenue-based financing model, and this is, again, I think this would be news to a lot of people, but also quite an interesting point to a lot of people, which is in most alternate financing platforms, and especially when you're talking about revenue-based financing as a particular product, there is no interest, right? So wake up to that, like big news flash, there is no interest, right? So we say no collateral, no equity, no board seats, no bullshit, no excuses, no paperwork, and no interest. And the reason for that is, unfortunately, again, misconception was debt has always meant a loan has always meant interest. And interest is always something you owe to a money lender equals to Shylock, right? And which is a bad thing. So society has told us debt loans are bad. Now, when it comes to business financing, debt has always been there, right? And in revenue-based financing, we've tried, and why I kept saying it's a more founder-friendly model is we don't get into a complicated calculation of interest at all. A founder or business owner would know upfront what that So it's based on a flat fee model, and they know upfront what they're paying. So to break it down and give you an example, say we're underwriting a business for 10 lakhs and we charge a flat fee of 5%, right? As an example. So 5% of 10 lakhs is 50,000. And so 50,000 is the fee that we would charge. And the founder would know that upfront. So the way we would work is we would actually deduct that 50,000 upfront and give the founder the rest, right? The actual capital advance. And they would have to pay us the overall amount back at the end of the tenor. So because of the upfront pricing model, it becomes far more attractive, easier to understand because there's no hidden fees, no hidden charges whatsoever. And people know upfront exactly what they're paying to the company that's facilitating the funding. And they know exactly what their repayment structure would look like over the course of the tenor of the loan as well.
Okay. Oh, that's wonderful to know, and surprise to me too. So, tell me a bit more about the repayment structure you talk about. I've heard that it's sales performance based and it can fluctuate month to month. How does this like dynamic approach work, and how does it benefit startups?
Sure. So again, like I said at the beginning, I think, most businesses will have fluctuating revenue. It's not like, if a business is doing 20 lakhs a month, they're going to sustain 20 lakhs a month indefinitely. Of course, because a lot of businesses are also seasonal, you'll have ups and downs, right? So in a month, you might have revenues dramatically increase, but for whatever reason, there might be a few months that business is slow and those revenues dip. And the idea, again, to make revenue-based financing as a more founder-friendly alternative was simply to make sure that repayments are linked to revenues, right? So if your revenues increase, so do repayments. If revenues stop or slow down, so do repayments. It's as simple as that. And typically what we've seen is that model works better because there's less pressure on the business as opposed to traditional loan where you're stuck with an EMI payment every month, regardless of how well or poorly your business is doing. The feedback we've gotten is that, and again, I would say it's just in India. I think this model globally has exploded in the last 5 years, especially in the last 3 since COVID. I think prior to COVID, there might have been 10 or 15 companies doing revenue-based financing globally. A lot of them were traditional financial institutions in the US. Since COVID, there's probably upwards of 70 companies doing this in different parts of the world, right? So it's very clear to see that this kind of a model is being widely embraced and adopted by business owners all over the world. And I think the other unique thing to India, which you're also seeing in the US now, funnily enough, is while the US started with the same way we tried to here, which was digital businesses first, it's now pivoting. So you're starting to see a lot of RBF platforms emerge in the US that are doing brick and mortar, like designed for brick and mortar businesses and you see this in India, right? I mean, you walk out of your house and you'll have, your kirana dukan, you'll have, some sandwich wala or something on your block effectively. And as opposed to here in the US, over there, the mom and pop establishment is like a family run business. Here it might be too, although revenues might be a little bit lower and a little less brick and mortar as opposed to just like a cart or something like that. But the premise is the same, where here what you're starting to see now is, while we started with a digital first approach as well, you're also starting to see a lot of traditional businesses that are now trying to go online. So as these businesses start to look at generating more revenues online and looking at other online economic opportunities, our ability to underwrite them grows, because like I said, we look at traditional and alternate forms of data, right? We don't just look at one. And I think being able to really look at a business holistically, where it's not just, hey, what are you selling offline? Or what are you selling just on Flipkart? Or what are you selling just on your Shopify store? That's not what we do. We look at all sources of revenue, right? And all sources of cash flow coming into a business. So there's a big difference today, I think, even in terms of how we do it as an independent alternate financing company, and how even traditional marketplaces and other areas where merchants essentially are driving commerce operate in the kind of financial solutions you find over there.
That's wonderful to know. It means like this comprehensive approach of looking at data is helping you basically walk side by side instead of trying to keep an upper hand leverage over the startups. So help me
Yeah.
understand now that we know debt financing a bit more better. What puts GetVantage at a unique value in this domain, in this specific domain?
There are about 7 to 10 million SMEs that have some sort of revenues coming in from digital channels or online channels. And the credit opportunity or the working capital requirement for these businesses today is upwards of $220 billion. But out of the 220, only about 50 billion is actually being met, right? There's a
Oh,
deficit of some $160 billion, which is insane. And so with all of the banks, all your traditional financial institutions, all of the NBFCs, and whatever few alternate financing companies exist in the country today, there's still a $160 billion deficit. And that's going to grow over the next 5 years to something like $570 billion, right? So there is this massive opportunity. We all have a part to play. And I think, so one is we're in the right place, right time. Two, I think revenue-based financing and alternate financing is going to become an invaluable part of the capital stack for any business owner that's looking to grow and scale up in India, especially. And number three, we're the only company that has its own NBFC license. So in February, we became the first and the only alternate financing platform to also secure a fresh NBFC license from the RBI. And that allows us to also raise more funding for our own book and start to deploy that capital as a co-lending model alongside other funding partners that we work with.
so Karun, like this is a massive opportunity, but doesn't it put you in an interesting space competing with banks, and especially government funded organizations and setups wherein they already could have access to maybe better financing models supported by the government?
So no. So the short answer is no, and the reason for that is simply, Priyanshi, that if we were competing, then there wouldn't be a deficit, right? Because there is such a huge deficit, there is a massive opportunity for us, and not just when I say us, I don't mean about us and what our market share or our piece of the pie is going to be. It's way too early for that. Right now, the focus for everyone operating in this space, whether you're a bank, you're an NBFC, you're a government supported entity, or you're an alternate financing platform like us, should simply be how can we grow the pie for everyone and make funding more accessible, right? Like it goes back to the first thing I said, which was businesses need different forms of capital at different times, right? Sometimes we will be a better option. Sometimes an equity funder will be a VC might be a better option. Sometimes a government grant may be a better option. Sometimes a bank loan will be a better option because yes, if eventually and if you get to that kind of scale, banks will give you the best rates possible, right? The advantages with companies like us is it's very quick. Sure, today you might pay a premium for it, but again, ours is risk-based or dynamic pricing as well. So as a company is able to mature with us, the rates we're able to offer those companies typically get better as that company's overall business fundamentals improve as well. So, and I think my biggest ask more than anything, and what I believe we need to do, and not just we as a company, but my biggest ask for the industry is stop looking at each other as competition. There is no competition, right? We have to look at each other as the founding members of building this sector, right? And this sector is only going to grow, and that share of overall pie of alternate financing in the overall financing landscape for SMEs in India is only going to be able to get achieved if we work collaboratively and alongside each other, right? So it's not about, hey, how many companies is that company funded as opposed to GetVantage, or how many companies have I funded, or what is my AUM? It honestly, it doesn't matter at this point because we're so early. I think the industry, when I say the industry, not just the companies that are in the alternate financing space, but the banks, the traditional lenders, the banks, the NBFCs, ourselves, government, will all have to collaborate if we're to succeed. And if we are collectively able to design the solutions and have the dry powder available to bridge that gap of $160 billion today, right, which is supposed to increase, double up over the next 5 years. It's not going to be able to be achieved by one company or one entity alone or one sector alone. It is going to be a collaborative effort, and there's money to be made. There's massive opportunities for everyone, and I think at the end of the day, if we're able to even, you do the math, right? 10% of that becomes 16, 1% of that becomes 1.6, 0.5% of that becomes $500 million. So, like, you can go as small as you want, and there's still an opportunity there. So
Yep.
I think it's really about understanding the bigger picture and trying to figure out how we can work collaboratively. And that's one of the things we're doing, right? Is we're trying to do a lot more community-driven events, engagement activities, really trying to galvanize the entire founder community to come together, talk to each other, share not just the good things that you all are doing, but also share the challenges and how you overcame them. I know there's tons of events that are happening offline these days. There's tons of industry events, etc., that are happening these days as well. But I think what often ends up happening is the focus tends to dilute the focus away from the core challenges and onto sort of ancillary challenges that you might be facing, which are a little bit more superficial, right? People don't really want to talk about fundraising out in the open, right? People don't want to talk about how hard or what kind of experience I had with this VC or this alternate financing firm or this other lender or this bank. You want to keep that behind closed doors. What you want to talk about on stage is, hey, what should I do on marketing? Or what is this other growth hack I have, right? And I think that needs to change a little bit, where the entire industry, and I mean all of us, not just, again, I'm not pointing the finger at anybody, but we need to, as an industry, help each other to understand, hey, there are pros and cons with each solution or each platform or each entity. How can we, to your point, how can we actually help each other improve, right? So are there learnings because of the tech-first approach a company like us has taken to fundraising? Are there any of those learnings or that tech stack that we can then port over and provide to VC firms, right? Absolutely, there are. And I think being able to drive that knowledge exchange, that knowledge sharing, is also going to help in the long run, not just for us to improve, but for us to be able to improve our products and services to benefit the founders and entrepreneurs who need it most.
That's wonderful. That's a great answer, to say the least. And talking more granularly, one thing that VC funding has sort of cracked is going beyond just the growth capital. Since it has been in the industry for so long, startups are also attracted because they become a part of a community. They get access to resources, mentorship, and just this lifelong partnership. Do you think alternate financing is also following a similar path, or how is GetVantage helping startups it supports go beyond just the funding model?
Absolutely. So you're spot on. Great point that you've mentioned as well. Again, I think VCs could have definitely done more. Firstly, I think there's some VCs out there that have become synonymous with actually trying to help the founders in their portfolio and grow. But I think most VCs tend to only look at numbers, unfortunately, and maybe aren't that helpful. Again, this is based on personal experience, feedback we've seen from other founders, etc., as well. So I think, one, we need to stop shying away from having tough conversations, right? And founders need to understand that, I mean, if you're selling your company, you're part of your company to a venture capitalist, by all means, you should be reaching out to them for help and support as often as required. That's what they're there for, right? But I think a lot of VCs tend to be a little bit more reactive than proactive as well. So I think overall as an industry that should change. And I think the way we've tried to approach this problem differently is simply that from the onset, we decided that our principle when dealing with any founder is going to be driven by 4 C's. Actually 5, but we typically say 4, which is capital, which obviously we provide, and that's what we're here for. That's our, I wouldn't say a primary, but that's our core support function, is to provide the capital when you need it on tap. But it's community, collaboration, content, and the last one is customer. So I'll get to the last one in a second. But the other 3 are quite important as well. So like I said, we provide a really strong and close-knit founder community. As we funded over 650 businesses today, those are 600 plus founders that we have as part of our community. We've obviously interacted with far more, so which number into the thousands. And the idea is to be able to galvanize that community, bring them together, whether it's offline or online, and have them interact with each other more than us trying to essentially foster an interaction, right? I think there is a huge scope for people to share ideas, share problems, ask for feedback, ask for advice, ask for support directly without the need for a moderator. And that's one of the things we try and do is bring that community together and make sure that that community is there to help, right? It's also, and that stemmed from one of these initiatives we started about 2 years ago, which was called Founders for Founders, which was a group of founders and operators within our network that we brought together. So it was a panel of about 15 or 20 people that we brought together. And it essentially became a forum where any entrepreneur, it didn't have to just be founders in our portfolio, but any entrepreneur could actually reach out to these 15 or 20 people to book time with them for a no strings attached chat, right? So you could speak to this person about anything. And of course, whether you're talking to a venture capitalist, they might be able to help you in fundraising. If you're talking to a marketer, they might be able to help you in growth. If you're talking to an ex-founder, he or she might be able to tell you about certain challenges that you're going through and how they overcame them, or give you other perspective in any kind of issue that you might have in building your own company. So it was just to be able to get time with these people who otherwise might be hard to access. And so the community aspect stems from that. The collaboration aspect that I mentioned also stems from that. We try and foster a lot of collaboration between founders and brands in our portfolio, as well as with people, obviously, because I think that's where it all stems from. We're not computers talking to each other. We are humans talking to each other at the end of the day. So relationships are really important, and trying to foster that collaboration is key. And the last one I said was content, right? I think the other big thing that most young businesses require today is some perspective or some direction around overall brand communications, and how do you sort of build that and focus on that. So what we try and do is, because we have a lot of strong storytellers within our firm and people with a lot of background in that space, including myself, is really try and consult founders and brands that we work with on content, right? And help them design and create content as well, which can drive their narrative forward. And I think that becomes quite key. So we try and focus on those 4 C's. And the one I left out, which I said I'll come back to, is customer. For us, customer should be at the center of almost every decision you're making. And that's what we try and inculcate in the brands as well, is always put your customer front and center, and then go back and look at the problem, right? So when you think about sort of, if you try and approach a problem with first principles thinking, put them as part of your first principles, right? Like really understand why you're trying to solve that problem and what the crux of it is, and then try and design a solution accordingly.
I see. So I'll rephrase my question a bit, and I'll see if your answer changes. There is a mindset in startup founders that even if when I'm diluting a part of my company, I'm bringing on board the VC as a part of the company, and hence be getting continuous support in their collaboration as I grow. Whereas in terms of debt financing, there is nothing in, like, GetVantage's favor to continue helping me, or not enough to continue helping me, because they don't own a part of the company. They're not really a part of the company. So what are your thoughts about this mindset?
Yeah, so I think that mindset needs to simply shift, right? Because I think there's enough examples of VCs coming onto a cap table, or any investor coming onto a cap table, but just being a name and providing zero support, right? So again, if you're again, depending on what stage of business you're in, if you have a strong idea and or you found product market fit, you've built a strong enough business, you're generating some revenues, typically funding is not hard. You'll have people line up to fund your business, right? So what is the actual value add you're going to get in picking 5 out of 50 names? That's something you need to actually understand very deeply, right? I think the advantage with a company like GetVantage is simply that from the onset, we say these are the areas we're going to help you in, right? So you know upfront that, okay, you're going to get community support. You're going to get opportunities to collaborate with other companies, founders within our ecosystem. You're going to get a ton of support around content and designing that content and overall brand com strategy. And of course, in addition, which VCs cannot do, and a huge differentiator is, you have the ability to have capital on tap, right? Venture capital is only when if you want to reach out to a venture capitalist 4 months after you've just raised money and say, hey, I need more money, they're probably going to say, come back in 6 months, right? I'm not going to fund another X amount in your company today because that valuation isn't going up, right? Whereas with a company like GetVantage, almost whenever you have a requirement for additional working capital, 9 times out of 10, you'll be able to get it, right? The only time you may not be able to get it is obviously if within a month of raising a round with us, you're like, I need more money. Wait, you're like, hold on, wait, something might be amiss here. But 9 times out of 10, you will, because your working capital requirement will arise again within 3 months or within 4 months or 5 months, which is a good enough time for us to have not only got paid back a large amount of that previous advance that we've shared, but also have built our own confidence with the business. So it really is capital on tap, which very few companies or entities can actually provide.
That's actually interesting because it's fostering basically a continuous collaboration with the company you're supporting and actually making you a part of their success journey or their entire journey altogether.
Absolutely, you're spot on. And I think the other thing, and that also stems from how do we start to iterate and innovate on our own product stack and our offering for businesses is, on one side, you have financing. On the other side, we know one of the biggest use cases, as we were discussing earlier, is it's not just marketing, but it's also things like vendor payments, right? So the platform has the ability for companies to make those payments through our platform, whether you're making GST payments, where you're paying certain vendors that you want to prove through the platform. All of that's possible. So then you start to look at what is the overall finance, how can you support in different financial aspects for a company as well. So that really drives how we innovate and iterate on products too.
Interesting. Okay, so a bit about your personal experience. You have extensive experience in corporate affairs, development, and strategic partnership. You've been a director at Discovery Networks and head of communications at Uber Asia. Tell us how your background prepared you for leading growth efforts here at GetVantage and supporting startups in their fundraising journey.
Wow, I think you're one of the first interviewers who's asked me very interesting question after interesting question. So no, I think I think anybody who's been in the startup ecosystem, especially over the last sort of 10, 12 years in India, would probably be in a great position to drive growth at any company, right? And I think what really helped me was being very early at Uber in Asia. I think I was employee number 7 in Asia or something way back in 2014. And was with that company for 2 years through the most challenging times as well as the times of exponential growth. And it was the company was launching in 1 new city a day or 2 new cities a day at the time. So you can imagine how quickly the company was expanding, right? But it taught me a couple of things. One is prioritization, 2 is collaboration, and 3 is execution, right? While we all say strategy eats culture for breakfast and all of that stuff, or culture eats strategy for breakfast. But sometimes I think we tend to spend too much time and effort on strategy. While it is absolutely critical, don't get me wrong, but so is execution, right? And at some point you'll understand that getting whether you're pushing product or you're pushing a new feature or a new service or whatever it is, sure, as a founder, you might be like, man, I want this to be of like 100% quality. But sometimes you're like, okay, 85% is fine. Just get it out there and spend the 2 weeks, the next 2 weeks or the next month iterating and improving on it, right? I think that like going to market is one really important, which I understood very quickly at Uber, was just how quickly we have to go to market, support, scale, and do it again, like repeat, right? Two was, I said, prioritization as well. I think in any startup and like a company like ours, we're a fast growing company, we're doing upwards of 40, 50 investments a month, right? So that's more than one investment a day, essentially. You have to be able to prioritize very quickly because the workload is never decreasing, it's always increasing, right? And the number of, because of that, because the team is increasing, the number of customers you have is increasing, the amount of work you're doing is increasing. So are your problems, right? So are the things that are breaking. And you have to be able to prioritize and really start tackling each problem very quickly, because otherwise you're just going to have a never-ending increasing pile of things that is never diminishing either. So prioritization is something I learned very quickly again over the course of my career, and it's helped me really well here so far. And the last one, again, not in any order, was collaboration, right? And by collaboration, I simply mean really understanding deeply the meaning of teamwork and the fact that it's not about who takes credit, right? In any small, fast-growing startup, even once you get to bigger teams and bigger companies, right? People start to become political. People like, that's my deal, or I did this and I need to get credit for this. And if you're in a fast-growing startup, you very quickly realize that there's no time for that. It really doesn't, like, it's not about who gets the credit or who's driving this. It's simply about how can I contribute to the best of my ability in the shortest time possible to the outcome that we need, right? I'm not even talking about output. I'm talking about business outcome, right? And I think that's really key. That's really important to understand. And I think, it takes time, and especially the younger generation, it takes them a little bit more time to understand that. But it's up to us people, us leaders or people who've been around a little bit more, to really try and inculcate that culture into our teams, where, and again, if you start to look at all of these, whether in silos or together, you'll start to see that, the time constraint that you have is sort of an undertone to all of them, right?
Yep.
And you really need to be able to drive the execution, because otherwise you're just going to be caught in endless strategy discussions as well.
We've all been there, haven't we?
Yeah, too many times.
So last question, and thanks for an amazing answer again. Last question for you, for founders and entrepreneurs and our audience looking at this. What is the piece of advice that you would offer, both for navigating this complex world of fundraising and...
Sure. So I'll keep it very simple. See, the whole point of a company like GetVantage on our platform is to make funding frictionless, right? Is to make it hassle-free, is to make it more founder-friendly. So please do your research, right? There's this, I've been in the crypto space a long time, and there was this little acronym that we had in crypto called DYOR, which was do your own research. So please educate yourselves on the ins and outs of your business finances. Like, you should also be a CFO firstly. And part of that education is really understanding what all of your options are and when is the right time to leverage them, right? And the last thing I'll simply say is debt is cheaper than equity. Don't let anybody tell you otherwise. And again, if you understand how, why, when, it won't be an if, it'll be a when are you coming to us to work with us, not if you're coming to us.